Good evening, everyone. A very warm welcome to the brand new episode of Meet a Member series. As you know that in this kind of series, we give you access to the industry experts, wherein you can ask your career-related questions directly from them. I'm Rajni Nameja. I'm your host for the evening. As a quick introduction, I'm a CFA holder and a volunteer with CFA Society. As a part of my day job, I work with ICICI Bank into fixed income space. Friends, our today's guest is Jatin Khemani. He is managing partner and CIO of Stalwart Investment Advisors. He has been associated with the equity markets for more than a decade now. His firm's model portfolio has delivered the return of over 22% since inception, which is 2014. Later on, Jatin co-founded Indian Investing Conclave, which provides online access to the best equity minds in India. Apart from that, Jatin is also associated with him in his philanthropic role with Art of Living, and his firm has made various donations to various philanthropic organizations. So, as I hand over the session to Jatin, I would request each one of you to keep on posting your questions in the chat box. We will give an opportunity to you towards the later half of the session to come on the screen and ask the questions directly from Jatin. Over to you, Jatin.
Am I audible?
Yes, you are.
Thank you, Rajni, for that kind introduction. Also, thank you to Somik and Vidhi for inviting me here and organizing this. So a warm welcome to everybody who has taken out time on a Friday evening to join this session. So what I'll do is I'll share my journey over next 20-25 minutes, and post that we'll open the session for Q&A. As Rajni said, you can also keep posting your questions in the chat box and we'll address them after my initial remarks. So I am, as Rajni shared, I'm Jatin Khemani. I am 33 years old. I am married and settled in Delhi. I have been into equity markets for the last 11 years, since the very beginning of my career. Before I share my equity journey, I'll just quickly share my background and how I got into equity. So I was born and brought up in Delhi. I come from a family which, while my upbringing had very limited means, but my mom ensured I continue to study in private school. I wasn't a very bright student for most of my schooling, but when I entered class 10, I don't know whether it was the pressure of boards or what, I realized the importance and the need to focus on my education if I wanted to achieve something in life. So it was a turning point. I studied so much that year, and I ended up topping my school in science. But on my parents' suggestions, I opted for commerce. Fell in love with accounts, economics, business studies. What joy we have, if you remember, and if you're a commerce student, when in accounts your balance sheet matches, right? It is a nirvana moment. But at the same time, I found CA as a bit of a technical career choice. So I instead went ahead and did my BCom honors from Delhi University and parallelly studied for MBA. I then went to Christ University, Bangalore to pursue MBA in finance. So until this point in time, it was not that I had already decided I wanted to get into equities. In fact, it's other way around. Being a Delhiite, coming from a business family, my impression of equity for me was pretty much the opposite. My father had dabbled in equities and did not have a good experience. So was the case with a lot of other relatives and friends and family. So the message that was passed on to me was that equity is speculative. An ordinary retail investor does not stand a chance to make money here. It is rigged. Operators If you have heard that term, that was very popular in 90s. It is driven by operators. So that was the impression I had for equity. I never met a guy who had intellectually pursued this profession and created wealth. But that was supposed to change in my MBA when I found two amazing mentors who were visiting faculty in my college, and they had become financially independent by investing in markets. And this was for the first time I was meeting somebody and realizing that this can be a full-time profession. This can be a path to financial independence. And by the way, I was getting introduced for the first time to the concept of financial independence. They made me read books like One Upon Wall Street by Peter Lynch. That was a nirvana moment for me. They made me read books like Rich Dad, Poor Dad by Robert Kiyosaki. That was my introduction to financial independence. And the whole idea that you save enough and invest that money to compound on itself so that you don't have to worry for a monthly check sounded so liberating, right? And I just fell in love with equities by in that year. And they also introduced me to CFA. So I enrolled myself into CFA level 1 in the second year of MBA. And that was the turning point in terms of my orientation towards equity. But it was 2010-11, if you remember, was the aftermath of global financial crisis. There was no job in the campus for equities. So coming from a Sindhi business family, I realized, okay, the next best asset class where I think I can do well is real estate. So the first job placement I sat for in the campus was for a Fortune 500 real estate company. It was the most sought after job in my campus. Practically entire batch of 300 people, 300 candidates sat for it. And after muted. Yeah. So after 12 hours of rigorous 6-7 rounds, they made offer to 2 candidates, and I was one of them. So I joined the job, but it was the feeling was like you love somebody else, but you're forced to marry somebody else, right? The feeling was that bad, and I deliberated, and before they could make me sign that 2-year bond, on 27th day, I quit my job and I came back to Delhi. It wasn't an easy decision because I had a student loan on my head. There was an EMI which was supposed to be paid every month, but my mentor was supportive, my family was supportive. So it was a very difficult decision, but I somehow took it, quit the job on 27th day, came back to Delhi. And then next 6 months were full of challenges because I kept on looking for a relevant profile, but it was very hard to find one. But luckily, I found one at a leading independent research house in Noida. It was a 30-year-old outfit. I worked there for a year. And this job was actually for a very junior role. And they said, you are way overqualified for the job. And the job salary was 60-70% lower than the campus placement I had. But I convinced them to give me that role because I knew the profile was right for me. I was not focusing on the salary cut or whether I was overqualified for the job. I desperately wanted a break into the industry and to learn that skill set, which will eventually help me become a better investor myself. And I'm glad the firm gave me an opportunity. Over next 1 year, I got a lot of exposure there. So I was a part of a small team, a research team where based on Peter Lynch principles and growth at reasonable price strategies, we are looking for promising small and mid caps. And I was fortunate that a lot of my research actually got published in one of the top 5 investment magazines of the country. And in hindsight, some of the stocks I wrote on, like Bajaj Finance, went on to be the biggest wealth creator of this decade. I was widely read, but at the same time, I realized that this is not the mainstream industry, right? I wanted to eventually move to buy side, or at least a family office where I be a part of the action. I know who is acting on my research, how is it turning out to be, and learn the job more intricately. So after a year of working here, I was looking for other opportunities, and I cracked an interview for a family office, and they happened to read my research from this magazine, and that's how I got an opportunity to interview with them, and I luckily cleared that. Again, that was a small family office based out of Delhi, uh, and the directors were in the markets for 3 decades. I got some really good exposure there, uh, more than you could have asked for at that level of experience. I was traveling across the country, meeting promoters, attending AGMs, seeing plants, participating in con calls. So they were very well connected in the industry, and they gave me a free hand to do research. And they were investing on my research. So there was a lot of motivation to look for newer ideas and apply whatever I was learning in CFA. I was parallelly studying level 2 and then level 3. So it was very exciting to be part of that job. I could not have asked for more exposure, just being in third and fourth year of my career. So after 2014, the next obvious growth option was to head to Mumbai, because that's where 95% of the industry is, right? All the leading institutions are there. So that was the choice I had at that time. But I was not very sure if I wanted to move base, and I was very attached to my family. I wanted to stay here. I was not sure if I go back, when I would come back, or if I would be able to come back ever. Because once you be a part of that industry, and that's where the industry is, it's very difficult to uproot yourself and come back. So, and being a Sindhi, my DNA had business forever. So I decided that, okay, let me start my professional, my entrepreneurial journey. And SEBI had just come out with investment advisors license regulation at that time. I applied for it. It took me 6 months to get the license. I was amongst the first 50 in India to get that license. I started an independent equity research house by the name of Stalwart Investment Advisors. We basically provided independent research to do-it-yourself investors, retail, HNI, NRIs, and institutions who can then act on it. So it was exactly like a PMS or a mutual fund, except the execution. So we would provide you an entire model portfolio, but ultimately you're executing the buy sell in your account yourself. So that was the differentiating point. Our clients were in full control of their capital in their existing demat account, while we were guiding them how to deploy that. The other differentiating point was I ensured skin in the game from day one. I was exactly investing in the same stocks along with the clients. So that was the beginning of Stalwart Investment Advisors in 2014. We were coming out of a bear market in small and mid caps. Modi ji had just come to power. Macros were aligning, and the next 3 years were no less than a dream run. Let me go to full screen mode. Yeah. So the next 3 years were no less than a dream run. The first idea we covered was Amrutanjan Healthcare. And within a month, Mr. Vijay Kedia started buying it, and it doubled in 30 days flat. After 6 months, we initiated coverage on a stock called Tasty Bite Eatables. And in the next 2.5 years, it went up 9 times. Such was the market, and such was the frenzy in small and mid caps. And we were also, of course, applying all the fundamental filters and whatever I had learned in CFA by reading the super investment textbooks, Warren Buffett, Peter Lynch, all of that I was applying in small and mid caps, identifying high quality businesses available at low valuations. And the portfolio probably compounded at 40-45% during this while. I got so much limelight. I was covered in Wizards of Dalal Street by CNBC TV 18 as the youngest analyst ever. It was hard to believe I was sitting across the table and being interviewed by the legendary investor, Mr. Ramesh Damani himself. I was all of 26 years old. But such is the cycle, right? If you catch it right, you get lucky and you apply yourself the right way. Those 3 years were amazing. And I was covered by Economic Times. At Flame Investment Lab, I presented some original research like consolidation wave. And through vote of 50 fund managers, I got the best prize in that alumni meet. At the same time, it was still my first cycle, right? And when it's your first cycle, you're prone to make a lot of mistakes too. I did my fair share of mistakes, which became obvious in 2018-19 bear market. For those of you who have been involved in markets as professional or as investors, you'll remember while headline indices like Sensex or Nifty did not correct too much in 2018-19, but the broader markets were badly butchered, right? The small cap index itself was down some 40-50%. Our portfolio too had a drawdown of 30-40%. Many stocks went down by 60-70%, right? It was a nightmare to go through that phase. Although a lot of our companies were doing fine fundamentally, there were a lot of technical reasons also because of mutual fund reclassification, flows, and of course, overall pressure in the economy, the broader markets, barring some 40-50 top 40-50 companies, had a very difficult time, even fundamentally, not just stock-wise. In fact, after this pain period of 2 years, I introspected a lot, I reflected a lot. There were a lot of mistakes we did, there were a lot of learnings we had through this cycle. And back in Jan 2020, I made a presentation for CFA Society titled My First Decade as a Full-Time Investor, Key Learnings and Mistakes. I delivered this presentation in Delhi chapter, Hyderabad, as well as Pune chapter. The recording is there on YouTube, and if you are an investor in market, if you're an analyst, I would recommend going through this because as Charlie Munger says, you don't have to pee on an electric fence to know not to do it. And life is too short to make all the mistakes yourself. So probably you can learn from some of the mistakes I made and avoid making them yourself. So somebody's pen is on. Okay, so January 2020, the markets were coming back. Our portfolio was up 20-25%, and things were getting better. And then we came out with a circular which changed the whole compliance of our setup. So to avoid all the compliance of a private limited company and having to file 50 different filings to MC every year, from day one, the way I had structured our advisory was I had an individual license from SEBI, and we had taken a GST. I had taken a GST, and it was registered as a sole proprietorship, just to keep things simple from an organization standpoint, from a compliance standpoint. Of course, you still had to meet all the SEBI compliance and the GST compliance and all that, but from an MCA standpoint, as a sole proprietor, things are relatively simpler. But in Jan 2020, SEBI out of nowhere said, if you are an individual analyst or an advisor having more than 250 clients, you must corporatize your setup. And that was a huge change because we had to restructure. We had to form a new, I had to form a new corporate body, apply to SEBI for a research analyst license. The whole process took a year. And then they said, because your existing license is investment advisor, you can't shift your existing clients to the new research analyst setup. I don't want to get into too much technicalities, may not be relevant to everybody here, but that year went into corporate restructuring, and it was a very lengthy and cumbersome process. And since we could not shift clients from existing entity, now I'm running two entities, one old proprietorship and one research analyst, and it'll take a while to merge the two. But at least the markets were recovering. Jan, Feb were pretty good for small and mid caps. And then COVID happened, and in March 2020, within 2 weeks, it started in first week of March, and by 27th March, the index was down 40%, small and mid caps were down 60, 70%. And there was a saying in markets to all the people like me who joined after 2008 that if you haven't seen the great financial crisis and that drop, you are a virgin, right? Because you don't know how much it pains to see your portfolios go down by 50, 60, 70% overnight. And you have only been investing with this QE liquidity tailwind after 2008. So you don't know what it means to live through cycles and what it does to your psychology to live in that uncertainty, see 60, 70% drawdowns in your portfolio. So finally in COVID crash, I could qualify that. And now I can say to all the people who join after COVID crash that you haven't seen a crash like that. You get bragging rights then. But it was a nightmare because as a large scale public advisor with own network also entirely invested into markets, and seeing your portfolio go down 50, 60% overnight and not knowing what would happen tomorrow, it shakes you, right, psychologically. No matter how much conviction you have fundamentally in your companies, but that drawdown and that uncertainty is very shaky, right? But I'm glad we not only survived that, but we did everything that was supposed to be done at a time like that. We had 10% cash in the portfolio, 8 to 10% depending on client entry. And we deployed all of that in March 2020. In fact, we actively rotated 25, 30% of our portfolio from some compounder type opportunities to much better opportunities that market provided at that time. And as they say, if you survive in the market, eventually you end up making a lot of money. Then 2021 bull market made it all great. We have been on steroids practically from last 18 months. As you know, everybody has made tons of money unless you were short or you were doing some FNO and you got margin calls. But if you are a long-term investor and if you were invested in the last 18 months, you have made a lot of money, right? Overall, as we complete almost 7.5 years this year, we'll complete 8 years by end of this year. We have made 23% CAGR since the inception in October 2014. And that's twice the market indices and top decile if you compare us with the comparable PMSs or mutual funds. So it has been a roller coaster journey in terms of performance, in terms of evolution, in terms of compliance, but it has been extremely exciting, fulfilling, and rewarding. I also co-founded another venture in 2017 called Indian Investing Conclave. Just like we are having this online session, in COVID, everybody has forced to go virtual, right? There is no other option. But we pioneered this in 2017 through Indian Investing Conclave, where it has been online only, as in virtual only from day one. The idea there is to let senior fund managers, experienced investors who have seen multiple cycles, share their investment thesis and their style of analysis on a chosen company, and let that distilled knowledge and framework flow down to the wider investing community at the comfort of their home. So, in last 10 years, I've been very fortunate to be invited every year to October Quest of Parag Parekh, which happens in Bombay every year in October. I have been part of Flame Investment Lab, which is extremely sought after, but every year only 50 people make it there and they get thousands of applications. Similarly, there are so many other forums where we meet every year, discuss, learn from each other. But I thought, what about the rest of the investing community who doesn't have the privilege, resources, time to be a part of this gathering, right? So that's when the idea of IIC came up. And it has been extremely rewarding, fulfilling, and exciting journey with IIC. in last 5 years, we have done 154 sessions with 80 plus instructors who've all been leading fund managers of the country, and across 8 IIC seasons and 24 alpha series with no paywall. And in the process, we've also been able to add some value to the NGOs we support, Art of Living, Perfect Foundation, and in 2020, we donated to PM Cares, cumulatively in last 5 years, more than 8 lakh rupees. So it has been a great journey. There has been so much value being added to the viewers. The speakers are happy getting that slot and sharing their views and getting feedback. And of course, it is great for us as organizer to facilitate that whole ecosystem. So that has been my journey of last 11 years. Before I hand over back to Rajni and we open for Q&A, I thought it'll be a good idea to share 7 key factors that I believe helped me positively in this journey. Now, some of them were purely luck. I was lucky, they fell in place. Some of them were deliberately chosen by me. I'll be happy if even 1 or 2 are relevant to you and help you in your journey. So the first big point was, in the beginning of our careers, we often get enticed to join larger firms. We feel it'll be good for our resume, a big brand name would be attached, we'll get to learn more, the job will be stable and whatnot. We have a lot of factors we justify when we are aspiring to join a larger, recognized establishment. But in my experience, if you really want to learn, if you want to have much more exposure than what your peers might have in larger firms, the idea of joining small firms, small teams makes a lot of sense. And by that, I don't mean a startup, right? So both the organizations I worked with were 25, 30 years old, right? They were not startups. But I had the opportunity to directly report to founders. I had the opportunity to not just stick to the profile and KRAs, but contribute wherever there is a requirement. And in small firms, there's always work, right? Outside of your domain. So you get to really work like an entrepreneur. They call it intrapreneur, right? And that prepares you so much better eventually whenever you want to be on your own or take larger roles in your corporate journey, right? So that's the first big factor that helped me in my journey in the beginning. Otherwise, you know, at the age of 24 or 25, I could have never gathered the courage to start an advisory setup, right? It's such a big responsibility. You're responsible for people's capital. On your advice, somebody could be investing his lifetime of savings. In those 3 years, I probably got 10 years of experience, comparable experience, what some peer in a large setup. Let's say if you join a large brokerage house as an associate, you will be working on one sector, supporting one analyst, and probably working on the numbers for the first few years, just making models. But in this setup, I was able to work market cap agnostic, sector agnostic, and I was not just working on a model, I was also studying the whole value chain end to end, going there with my directors, interviewing the management. There were so many softer skill sets I was acquiring in that process that helped me prepare for my journey. So the second is focusing on learning versus cash flow. And what I mean by this is, I took a big haircut when I joined my first job, right? But I was focusing on learning rather than cash flow. My idea was not to somehow get the maximum salary I can get in the market. My idea was to join a profile which will help me become a better investor myself. I was not focusing on the cash flow. I was okay making a lot less, but I eventually knew that if I learn this skill set and if I learn how to invest and be an investor myself, I'll be able to multiply that cash flow over the next decade or so, right? That was my focus. The other extreme of this is also absolutely fine. For example, the other extreme of this would be that you pick the job that pays you the highest right now, even though that may not be your passion, or that may not make you a better investor, but you outsource whatever you're making, whatever you're saving, to a money manager and let him multiply that for you. That is also absolutely fine. Both ways are fine, and you just need to pick what works better for you. There is also a third possibility, which is rare, that you get a great remuneration in a profile that you're passionate about. It happens rarely, but you're very lucky if you're in a profession that you love and you're also getting paid very well. So that's the best of both worlds. Third is frugality. So for the first 18 months of Stalwart Advisors, I was actually working from my apartment's two-wheeler garage. And there was just 3 workstations possible in that area. It was a 6x8 office. I would sit along with 2 of my interns. And I was not embarrassed at all operating from there. Even for an economics time shoot, the cameraman came there and he did my photo shoot in that garage itself. I just somehow wanted to ensure that we're not spending before we earn. And we did not do any ads. I did not hire any full-time resource till the time I was fully occupied with the work and the cash flows permitted that. So that was the third big factor. Fourth was building parallel cash flow stream. So in my case, I had a 7-year student loan. And it was obviously not easy to quit your job after 3 odd years, right? Because in 3 years, how much kitty can you save, and for how long will it last? And you have those monthly expenses. It could be a household expense in your case. It was an education loan in my case. It could be any other compulsive expense to support your dependents or whatever. But how do you ensure that those things are taken care of and you're able to quit your job and let go of that monthly cash flow? It's extremely difficult, right? So what I did in my case was, with the last 2 years of job, I started teaching at a CFA Institute and an MBA college where I was teaching finance only. When I cleared level 2, I started teaching level 2. When I cleared level 3, I started teaching level 3. And fortunately, I cleared all 3 in the first attempt. So I was, in 2012, I was teaching level 2, and in 2013, I was teaching level 3, along with MBA finance subjects. I was doing this on Saturday, Sunday, while I was focusing on my learning Monday to Friday. So when I started Stalwart Advisors, it continued to be that way. Monday to Friday, I was working all day on Stalwart. Saturday, Sunday, I was teaching them. And there were so many synergies in this arrangement, right? I was so lucky that way, that whatever I was studying Monday to Friday, I would go to college and share the same case studies. I did not have to prepare too much theoretical knowledge because I was practicing that day in, day out, right? And I stood out as a faculty because others were academicians. Every year through voting, I got the best faculty award. I would hire interns from my class. I would give them live case studies, and they all acted as interns for me. I eventually hired full-time resources from the very same class. So if I count the synergies, and those 25, 30 grams of monthly cash flows helped me sustain without putting any pressure on Stalwart to do anything near term for money, which may not be right otherwise. So I could give Stalwart all the time to grow without any cash flow pressure because I had a parallel cash flow stream. So that was the fourth factor that helped me in my journey. The fifth was, I often get asked by others who are starting their journey, entrepreneur journey, how do you get the first few clients? You are saying don't invest in advertisements. How do I get my first few clients? And if I don't get first few clients, how do I sustain and grow? So in my case, what I did was, I was, even while being in the job, I was actively blogging. I had a WordPress blog. I was also active on Twitter. So I wrote about companies like Relaxo Footwear, Page Industries, DFM, Foods. And in 2013, 14, 15, a lot of them went up 5 times, 10 times. There was a public track record I'd already built. So when I started offering this service for a fee, it was not that people did not know how would I do. There was some track record already built publicly. So my suggestion would be, even while you are in a job right now with no plans of doing anything for next few years, even then you must write a blog. You must be a bit active on social media. share your opinions. Some of them could be right, some of them could be wrong, but over time you will build a following, and you will not have to start from scratch whenever you go the entrepreneurial way. So that was the fifth one. The sixth is be ethical. When you start, you're small, you think nobody's noticing, but behave as if you're already very big. Don't do anything which you think which is wrong, and don't just comply with the ethics written in CFA books on paper, but comply in spirit too. So something may be applied, maybe something may be allowed by SEBI, but if you think that that puts your client interest on the back foot, don't do it. Markets are very tempting. Easy money looks very tempting. I have seen so many people do that. You know, buying before making clients buy. You know, you think there are ways to hide this, and there have been recent cases where mutual fund managers have done it in very stupid ways and buying in relatives' name. Even if you find a way where you think you can't get caught, don't do it. Be ethical, build trust. Reputation is your biggest asset in this industry, and it takes time. If you've built credibility, you're standing out, right? So do what is best, what is in best interest of your client, and trust me, he will be your brand ambassador. You don't need advertisement. You don't need to spend a penny for any brand ambassador. Your clients will refer clients to you, right? And that's how you grow. Finally, keep patience, believe in compounding. As an investor, as an advisor, it takes a decent amount of time, but then eventually it is magical, right? So it is like that Chinese bamboo tree. When you sow the seed for the first 5 years, you see nothing. There is nothing on the ground at all. And you wonder, is anything ever gonna come out of there? Have I even sown the seed, or was I mistaken? Nothing is happening, it's been 5 years. And then in the 6th year, suddenly it grows 50 to 100 feet, right? And you don't even, while you did not even realize it was there for the first 5 years. So all that while something was happening, right? That process was contributing, and then you suddenly have a J-curve effect, a hockey stick kind of a growth. Most of the people don't survive even one cycle. Very few survive 2 cycles. So markets reward you as long as you show up. You just have to survive. And to survive, you don't have to do great things. You have to avoid doing stupid things. Now, it's very difficult because it's so tempting. Greed takes over, and markets are so volatile. There are so many shortcuts. All you have to do is just avoid doing the stupid thing, and you will survive. As Charlie Munger says, all I want to know is where I'm going to die, so I never go there. Just invert and forget there is any success formula. Just focus on what is the failure formula, and don't do that, and you will be successful. And your success will be your own. There is no fixed formula for success, but there is a fixed formula for failure. So just avoid that. So those are the 7 big factors that contributed to whatever a little and short journey I have had in last 11 years. With that, Rajni, I think I am done with my sharing of journey and introduction. We can open the room for interaction. Ramanandan is saying that back then it felt like the bear market was here to stay. I think it's being referred for 2018-19. Yes, I agree with you.
Hi. So we having some problems with Rajni's line, but what we'll do is we're going to start taking questions from the viewers, from the audience. We'll go one by one. I see Subramaniam has raised his hand, so if you can open his line, please. And Subramaniam, you can go ahead with your question, followed by Bhavesh.
Hi, sir. Your story is extremely inspiring. Am I audible?
Yes.
Thank you. The story is extremely inspiring. Being in the very early age, you achieved a lot, and it is giving that inspiration for people who are in mid-20s. And I will jump onto the question. You have mentioned a small team, a big exposure. Right now, I have an experience of 1 year, less than 1 year. So most of the people in industry, we aspire to be in the brokerage, like we aspire to get into a brokerage firms, sell-side brokerage firms. And as you mentioned, like those firms, they focus particularly on one industry. So we have to do models. So can you give some examples for this small team? What kind of companies they will like? What kind of companies can we get in to have this exposure?
Sure. So, see, even that is not bad. Depends on what you want. So if you want to become a sector expert, that is the right way to do it. But if you want sector agnostic exposure like I had, joining boutique offices like PMS office, AIF, family offices, those are the outfits where you get that kind of exposure, because those are smaller teams, right? They don't have sector experts. For sector experts, they rely on sell side, whereas those guys are jack of all trades. So on such buy side outfits, you would generally find team of 5, 10, 20 people, depending on the AUM, and they would practically be involved in all the sectors themselves. That is one. The other is outfits like ourselves. So, or my first job, those are called independent equity research houses. We are sector agnostic, right? So again, small team, we are a 5-member core team right now. So at outfits like ours, again, you would find exposure to multiple sectors.
Okay, sir. Thank you. To focus on, like, to study a particular sector, what resource you would suggest? So if you want to be good with banking, so like you mentioned jack of all trades. So I feel like I want to know all the sectors, but I want to be a king of one or two sectors. So what would you suggest for those resources to be better with one or two sectors?
So there are so many resources out there, right? You can start with a brokerage report, which covers the entire sector. You routinely get 100 pagers from brokerages, leading brokerages, domestic and international, where entire sector is covered end to end. What is the value the sector adds? What are the leading players? How is the regulation? And to fine tune that understanding, the other ideal way or the parallel ideal way is to read the annual reports of the leading players. So for example, you said banking. So if I had to start from scratch in banking, what I would do is I would study the annual reports of HDFC Bank, ICICI, Axis, few private sector leading banks, and also few leading PSU banks like SBI. I would also attend their conference calls. You can also go through the transcripts. I would understand the landscape in terms of regulation, the most important part, right? Only then can you decipher number if you understand how a particular sector is doing its accounting. So a sector like banking is too technical. How they declare their NPAs, what are the bucketing, how do they provide for the doubtful loans, all of that, right? What is cost to income ratio? What is NPA? You have to build the basics of the foundation of that industry right from scratch. For that, you need to understand the regulation, the accounting, and obviously going through annual reports and con calls also give you a lot of exposure in respect to company as well as the industry.
Okay, sir. Thank you. Thank you very much, sir. Thank you for the chance.
Jatin, I'm really fascinated by the journey which you shared with us. So, one thing I would want to understand is that we kind of understood the factors which would have contributed to your success. Now, one particular aspect which I am very keen to know is that there would have been some moments of low also. Let's say recent COVID example where markets went down and you would have seen your client's portfolio going down, or when you took a call to take a haircut in your salary. What is the kind of frame of mind you keep to tackle those kind of situations? Jatin,
So,
am I audible?
yes, you
Yeah.
are, Rajni. Thank you for that question. There have been so many moments. I'm just spoiled for choice here, which one to cover.
The
11
one
years
which is
roller
close to
coaster.
your heart. The one which is close to your heart.
I think the most difficult one was in 2019-20 drawdowns, because see, in advisory, like any other money management outfit, whether be it a mutual fund or a PMS or an advisory, the worst part is that you get bulk of the new clients after your recent performance has been very good, right? So I wish I had a lot of clients in 2014, because that was a great starting point. But unfortunately, most of our clients came in 2017 when we were already peaking that cycle. And in 2018-19, when we had 30-40% drawdowns, for the people who made a lot of money in 14, 15, 16, it was just some drop in their profits. But for people who came in 2017, it was a drop in their capital. Just to explain it with an illustration, for somebody who came in 14, let's say 100 became 250 by 2017. And then when in 2018-19 that 250 became 170, it's still okay, because still you're 70% up. But for somebody who came in 2017-18 with 100, and that 100 became 70, when the capital value goes down, it hurts a lot, right? And I think a lot of them were also new to investing. And it was my first cycle with large-scale public advisory role. I would not have got so hurt if it was just my own capital. But seeing your client's capital go down, and a lot of them sending mails, getting feverish, put yourself in my shoes. It is somebody's retirement money. It is somebody's money kept for daughter's wedding. It is somebody's money kept for children's higher education. And while it's just been a year and the money is down 30%, in your heart, it will be 5x in the next 5-10 years. The money is going to grow, right? It's not going anywhere. The companies are rock solid. There won't be a permanent loss of capital. But here is this guy who is feeling jittery at the 30% drawdown. And if you can't convince him and you don't control the execution, he can still panic and sell and book that 30% notional loss into real loss. And while the markets will recover, and that's what happened. We are today at 23% CAGR, but some of our clients who panicked in 2018-19 and exited, for them it was a permanent loss of capital, right? They did not stay invested to benefit from the recovery. And I think that's the biggest challenge in advisory, because you don't control execution. Although in mutual fund and PMS too, it's a problem, because although you control execution there, people can still withdraw their money. You don't have a control. Even if you introduce lock-in, people will pay that 2% exit load and still withdraw the money. You can't control the flows. And it is human psychology. That's how it has been happening in every cycle, that people will come in after the returns have been made, and they will exit at the wrong time when they have drawdowns. I wish I could control that for my clients, and we try to do that now. We have made a lot of changes. Some of the stuff which was already there, now we are highlighting it much more. We have buy, hold, sell. It's not like a model portfolio where when you enter, you buy on that day's NAV. So if you bring money today and only 30% of my portfolio is in the buy range, you will sit on cash for that rest of the 70%. So we are trying to customize it at individual level at the time of entry, and trying to reduce that pain which a client has to go through, and eventually I have to go through as an advisor, because it is very difficult to live through that cycle when the other person is not patient or understanding. Although now we are very blessed that most of the clients have been with us for 4, 5, 6, 7 years, and they understand. And now when markets go down, we get mail, should we put more?
Hmm.
That's a sign of a mature client, right? It's lucky to be in that position when your client, instead of panicking in a down market, rather asking you, Jatin, should we put more money? And then either you happily say yes, or you say no, let's wait for now. That's a happy situation to be in. And fortunately, things have got that better now compared to the last cycle.
Yeah, so a related question has come with that.
Hello.
Yeah, Ravi, yeah, you can go next. Yeah.
Thank you so much, ma'am. So, Jatin sir, I want to ask one thing that right now I'm doing the CFA level 1.
Okay.
Yep. Just a second. Ma'am, there's a network issue with my side. So, if it is possible, can I share my video or like? Hello.
That's okay, Prince. I can hear you. Go ahead.
Yep. So, sir, my name is Bhavesh, and right now I'm doing the level 1 of CFA.
Yeah, we can hear you. You want to ask your question later on? In the meantime, yeah, go ahead.
So right now I'm doing the level 1. So in the future I have thought that to go for as an investment banker. So what you will suggest me in the future? Like how will I go forward?
Bhavesh, continue on your journey. Academics is the most important. And as you come closer to level 3 and you think you are ready to look for the right job, what you would need is the right network, right? And for that, you have to start now. So just like how you have joined this session, I'm sure there would be a lot of other CFA members who are investment bankers. They would guide you right. They would guide you better. But there are some generic rules which apply to all kinds of profiles, is that you have to network and be active in the community, be active on LinkedIn, and also talk to these guys and understand what skill set is the most relevant, and don't wait for the job to train you on that. Learn that right away as much as you can. For example, if you think financial modeling is an important skill set that you will need in an investment banking role, some of it is covered in CFA, but for a dedicated specialized training, you can join some course online or some training institute where you get hands-on on that skill set. So add through those certifications the required skill set, which will also help you stand out from other candidates when you will be applying for such a role. And networking goes without saying is the most important. With the right people, all the more important, because they are already ahead in the journey, right? Somebody could be 5 years ahead, somebody could be 10 years ahead. They'll be the best people to guide you because they know what it is to be at your level and how they moved ahead. So they'll be the best people to guide and network with.
So if I apply for some of the internships, so will it be helpful for me?
Absolutely. Internships are the best way to get hands-on experience on a job and will help you crack the interview and do well when you finally join the industry.
Okay. And one last question, like after level 1, so can I go for one job or directly go for the level 2 preparation? Because somehow I just know that after level 1 we will get the job, but a small salary. But I don't want salary. I need the experience. Like how will they, do the job work, or how the employee will work in that sector?
Right. So see, Bhavesh, I did my level 1 with MBA, level 2 and level 3 with a full-time job without a coaching, just by studying on weekends and while teaching also parallelly on weekends. So if I can manage that, you sure can manage that too. So you don't need to study full-time. There is no need to stay at home for a year and study for level 2, level 3. That frees up your time. Now, what you have to do with that time is your call. If you're willing to find a job, if you're willing to work and you're able to find a job, great, join it. but it should be relevant. It should not be some unrelated job, because that will not help you. If that's the case, you're better off interning in a relevant profile rather than working in an unrelated full-time role. Or you can go ahead and do some parallel trainings, some certification courses. My point is that CFA can be done with a full-time job or with other engagements. So see what's best other option is available to you.
Thank you so much, sir. Thank you so much.
Most welcome.
Yeah,
Hi,
we have
Jatin.
next question from Parikshit.
Okay. Hi, Jatin, and thank you for sharing your journey. It has so many ups and downs with so many learnings. I'm sure it was extremely satisfying, and thank you for giving your time. So my question is that actually I'm from an economics background, but I ventured out into fashion after that, and I started my own business. But now after the lockdown, I shut it down. And obviously in 2020 and 2021, like a lot of other people, I came into the market and I started reading about stuff. So it just clicked, and I now want to venture out into equity research analyst. So I got my certification from NISM, and I've enrolled myself in the CFA level 1, and my exam is in May. I exactly like you, I also want a job which has skin in the game and money is secondary. And like you, I've built another cash flow also, which is temporary, which takes care of me, my monthly expenses. So my question is, how can I, because I'm not from the industry and I don't have a experience in the industry, how can I go about finding my first job, which actually gives me an opportunity to have a skin in the game? And how do I go about networking? Because I'm from a completely different industry. Though I'm from an economics background, but I was into fashion for the last 2-3 years.
Hi, Parikshit. See, if you want to join a firm with skin in the game, where you're working directly with the team who is investing his own money, or
particularly buy side research.
Yeah, buy side research. Generally, those jobs are very few, and since they're very few, they're generally filled with a reference or directly. They don't mass publish this. So the first thing is, you would not find those job listings anywhere, right? That is the first thing. Now, if we can't find those job listings, how do we find how to go about it, right? So first, if I were in your position today, what I would do is I would make a list of all the outfits where I think I can learn, right? This could be, let's say I would go to SEBI's website and see which are the PMSs, AIFs in my city, right? Or if I'm open to relocation, then without that constraint, I'll see which are the PMSs where there is a decent AUM who might have a team, and where can I learn this kind of a thing. And you could be following those PMS managers or AIF managers on Twitter, on LinkedIn. You could be reading their newsletters, and that's how you would know what their thinking is, and what kind of setup do they have, whether there is room to accommodate an analyst. And then while applying, you would not just send your CV because they get bombarded with CVs every day. A cover letter is also not enough. The best way to apply for a job is to prove that you deserve it. And how do you prove you deserve it? By showcasing that you already know some skill set and you're not coming there just to learn. Small setups don't have time to train much. They are juggling between too many things. There is SEBI, there are clients, there is money managing, there are managing teams, they're managing their office administration. There is just too much going on at all times. Nobody likes to hire a fresher and then train him. But even if you're a fresher, but you know your art, and by know your art, I mean you're already investing, you already read annual reports and con calls, you're active on Value Picker, you know the basics. And then how do you prove that you can add some value? Send a write-up on a couple of companies, which could be long-only ideas. Or if you want to take a risk, you know their portfolio, and send a write-up on why they should not own one of the companies they already own, or they could own a peer of that company. This could be risky if you are making them go short on one of their ideas. Basically, you are giving them an antithesis on one of their holdings. This could be risky, but definitely you can send 5 bullet points on why they should look at this company with an attachment where you have a detailed thesis, right? Such mails tend to get opened, and once opened, such mails tend to get followed up too. You could get an invite, get a call to discuss, and it's a great way to break into a company. The usual sending CV, sending a DM on LinkedIn, these don't work anymore.
Thanks, Jatin. That's a wonderful idea. Actually, my follow-up question was that suppose I get an interview with one of these managers, what is the skill set which I should prepare for right now, which they might be testing in the interview? Because I have passed the examination, but I don't think that's enough. So
Yeah.
can you give me a list of any skill set which they would be checking? Because if I can read annual reports and if I can even make a report on one of the companies in their portfolio, maybe portfolio management or maybe financial modeling, if some skills which you can recommend for me to prepare for the interview?
See, it depends on the style of that firm. If they are very quant driven, then they would expect you to be on top of numbers, very good at Excel, financial modeling, projections. But if they are a outfit like ours, who are more qualitative focused, who are long term, who try to understand the business model really well, the value chain really well, look at softer factors on promoter quality, management quality, then it could be some other skill set, right? It could be better analysis of annual report, value chain, those sorts of things. So you have to really first understand what kind of firm and profile you're approaching them for before coming to the exact relevant skill set required to crack that interview. But if you try to be good at all these, this is an exhaustive list, right? If you can have a blend of quantitative and qualitative, that will help you in all sorts of interview.
Thank you, Jatin. That was really helpful.
You're welcome. Thank you.
May I request whenever any participant is asking questions to please switch on the video. Ritika, you can go next. Ritika, can you hear us? Alternatively, Hitesh Jain, you can go next. You can ask your question.
Hello, can you hear me?
Yeah, Ritika, go ahead.
Yeah, hi, sir. Thank you for sharing your experience, and that was very insightful. So, sir, I had a similar question. So, like, I have applied to I had a unrelevant work ex before I did my CFA, and I wanted to break in the industry. And as you told, like, we can start reading with the annual reports and con calls. So how else can we add value to our equity researching skills? I mean, how should we go about the companies, and what else can we do, to refine it?
Ritika, if you were asking this question in 90s, it would have been a very difficult job, right? Do you know at that time getting a hold of annual report copy was also very difficult. Now, it's not that I'm saying that from experience, but I've heard so many stories from seniors that even getting a copy of annual report was a very big task in 1990s. But we are so lucky today that everything is digitized, be it annual reports, be it conference calls. So conference calls and their transcripts and audio recordings, you can go to portals like Research Bytes, BY, researchbytes.com. There is Trendline. These mostly get uploaded on YouTube also. All the annual reports are available on BSE's website. There are great tools like screener.in. You get all the financial information, con call transcripts, annual reports, everything there. Most of the brokerage reports are available. There are so many financial blogs. There is so much discussion that happens on Twitter. There is a whole FinTweet community out there who is discussing stocks 24/7, right? So if you're active on Twitter and if you follow those 100, 200, 300 handles, you would be spoiled for choice. You'll be like, there is an information overload. What all can I absorb from this? So instead of asking, where can I get resources, you'll be asking which one of these is important and which one is to ignore, and it's too much for me. So today we live in an era of information overload. But as a fresher, we can start from anywhere, right? And we can see what is making sense to us, what is not making sense to us. And slowly and gradually, more and more things will make sense. And as you join the industry, things will also get optimized. You'll understand what is more important, what is less important, what is noise, what is signal. But from a starting standpoint, there is no dearth of resources out there. Just be online, just be active online, and there is so much out there.
Yeah, thank you, sir. And sir, like I wanted to ask one more thing about this resources that you just mentioned. So, I mean, like if I'm writing a report, so I am not good with, putting my ideas together in writing. So if I want to refine that part, how can I go about it, like specifically in terms with equity research? So how should I go about refining my writing skills and, putting together my ideas?
See, as you write more, you will get better. But you have to keep reading your reports and then compare them with other reports you're reading online from independent analysts, from brokerage houses. So many PMS fund managers publish their quarterly investment letters. At Stalwart, we have a guest dashboard, and tens of research reports we have published are available for free, right? So you have to see what others are doing and then compare your own report with that. And as you do that analysis over time, you're bound to get better.
Okay. And are there some books or something that I can refer for a good storytelling to put it out?
You're saying some books to understand the
storytelling. How do I
part?
go about like storytelling, like putting together my ideas in a concise and brief story?
The best is to read the actual stories being put out by others, right? People like us.
Okay.
That's the best.
Okay. Thank you, sir.
Welcome.
Yeah. Hello, sir. Thanks for the opportunity. I just want to ask that while I was going through the CFA curriculum, reading equity markets, fixed markets, it is very lively and it is very fascinating. But I am feeling that I can't get a feel of it. It is like waterfall is flowing in my imagination, but I cannot feel it. I can't touch it. How can I do it with my continuation of work? Because I'm in a different industry and I'm working somewhere full time. But it is very interesting. This industry fascinates me. So how can I get a feel of it? How can I get to know this industry more? Just want to know this.
Prince, देखो अभी तो स्विमिंग पे थ्योरी पढ़ रहे हो.
Yeah, sir.
फील तो तभी आएगी ना जब पानी में गोता लगाओगे.
Okay.
कूदना पड़ेगा पानी में, और पानी में कूदोगे तभी थोड़ा सा डूबोगे, फिर थोड़ा सा संभलोगे और फिर सीख जाओगे और स्विम कर लोगे, है ना?
Okay.
उसके लिए क्या करना है? एक डीमैट अकाउंट खोलना है, एक ट्रेडिंग अकाउंट खोलना है, चाहे 1000 रुपए हो, कोई बात नहीं, उससे कुछ शेयर्स लेने हैं, फिर क्यों लेने हैं, वो एक थीसिस लिखनी है, फिर वो ऊपर जा रहे हैं नीचे जा रहे हैं, थोड़ा सा देखना है, फिर उसका रिजल्ट आएगा, उसकी कॉन कॉल सुननी है. एब्सोल्यूट अमाउंट डज नॉट मैटर, बट लिविंग थ्रू दैट प्रोसेस मैटर्स. एंड जब तक पैसा नहीं डालोगे वो थ्योरी है, और 100 रुपए भी डाल दोगे ना, तो लुक एट द वे आपका जिस तरह इंटरेस्ट चेंज होगा ना, इट्स मैजिकल. Once you have skin in the game, na, your interest multiplies like anything, and you will be much more. You'll start behaving like an investor rather than theoretically like a CFA candidate or a budding analyst. Think like an investor. Do it yourself. Start from somewhere. Make mistakes. No problem.
Okay, sir. As you said, I used to listen with conference calls, certain conference calls on in which companies I am interested. Just it is like that. If I am reading about fixed income market, then there are so many things we can only study. How can I get into them? How can I sort of get a knowledge of them in real world?
देखो 50 चीजें पढ़ रहे हो, सबका तो एक्सपीरियंस नहीं हो सकता. अभी बंजी जंपिंग भी देख रहे हो, स्विमिंग भी देख रहे हो, 10 स्पोर्ट्स देख रहे हो, साइकिलिंग भी. कुछ एक्सेसिबल है, सब कुछ एक्सेसिबल नहीं होगा. कुछ चीजों को एक्सपीरियंस से सीखो, कुछ को थ्योरेटिकली अप्रिशिएट करो. दैट इज इनफ, एंड इवेंचुअली यू विल बी जॉइनिंग जस्ट वन सच प्रोफाइल. यू नॉट सी CFA prepares you for, there are 10 subjects and 100 sub parts to it, right? क्या क्या एक्सपीरियंस करोगे? अल्टीमेटली प्रोफाइल तो एक ही ज्वाइन करोगे ना, और एक ही चीज करोगे, एंड फॉर अ व्हाइल यू विल ट्राई टू बी गुड एट इट.
Okay.
And then over time add one more skill set and the third skill set and the fourth skill set. But अभी day one पे सब कुछ तो नहीं करोगे, वो तो CEO करता है, और CEO भी नहीं करता, वो भी delegate करता है सबको. CIO के पास भी CIO equity अलग होता है, CIO debt अलग होता है. आप बोल रहे हो मुझे दोनों में खेलना है.
Okay.
Beginning as a fresher. So सब कुछ experience नहीं कर सकते, काफी कुछ institutional भी पढ़ोगे, private equity भी पढ़ोगे, treasury भी पढ़ोगे, कैसे करोगे experience?
Yeah.
है ना? जो B2B enterprise type है, उसको theoretically appreciate करो. जो B2C में accessible है, डीमैट अकाउंट खोल के access किया जा सकता है, उसको live through that experience.
Okay.
And keep the experiment small, which you can afford to lose. 500 रुपए का नोट गिर जाए, दुख नहीं होगा ना, तो उतना ही डालो. This is just to live through that experience, not make money अभी.
Okay.
ठीक है? If you get into that to make money ना, तो पढ़ाई से ध्यान हट जाएगा और पैसा भी नहीं बनेगा for sure.
Yeah.
So just live that experience with a tiny experiment and focus on studies otherwise.
Okay, sir. Thank you. Thank you, sir.
Thank you, Prince. Ronak, you can go next, please.
Yeah, hi Jatin, Ronak here. First of all, thanks a lot for sharing your story. It's truly inspiring. And secondly, basically my question is that I actually work for a global financial services KPO, and I'm at a decent position, and I've recently given my CFA level 3, and I'm expecting the result. So I'm already in the industry, but truly what drives me is getting into portfolio management, and so that's where I actually want to end up. So from what I understood from your story, that you took a haircut when you actually moved from like a good corporate job to starting your own thing, and maybe you're like your entire journey. So is that the only way, or like say a few years, because I have significant years of experience in this field, and does that translate well to does that bode well for me if I want to make that switch to portfolio management? And how would that work?
Hi Ronak, first of all the best for your level 3 results. This is a very personal call, right? And ideally, the sooner you make the switch, the easier it is, because eventually your responsibilities only go up in life, right? You get married, you have kids, and you get into midlife. And then when you think about changing career and letting go of that cash flow and starting from scratch, it becomes extremely difficult. So the sooner you do it, the better it is. I don't know the exact circumstances you are in right now. If your circumstances allow you to do it and you're extremely passionate and that's what you want to do, you can think about it. Otherwise, if you're happy in your role and you're making good money, you can still use those cash flows to privately invest for yourself and enjoy that passion as a hobby. And that will also be rewarding, right? Because you are still investing your own money and growing it. The other is an extreme option where you let go of this cash flow, take a haircut, restart your profession from scratch. But as I said, that would depend on your individual circumstances.
Yeah, thanks for the advice. But that's what I'm trying to understand. Does like say I do have like a sell side sort of a profile, and I do a lot of equity research for some of my clients. And would that translate well into if I do want to like apply for some portfolio management services, like a company or something for a new profile in that field? Would that I really like the advice that you gave to Parikshit, for example. So do you have like a similar sort of way that I could take, which maybe shows, because I do some private investing, like based on my company's rules, of course, because I have compliance protocols to follow. But I mean, as I said, I want to like make that switch in case. So how should I go about it if I do want to, without taking a massive haircut, and like how can I project myself in the best light that I am capable of doing it, and be able to make that switch, if you have any clue?
See, Ronak, the biggest difference between buy side, sell side, and the KPO work you're doing is of the mindset, right?
Yeah.
You approach things, or generally in a KPO, things are approached with a spreadsheet mind. In sell side, things are approached with projections and similar mindset. Whereas on the buy side, it is more thinking like an investor, where you're putting money to work going deeper into things, understanding more, thinking more long term, not quarterly, not focusing too much on numbers, just the numbers. So but at the same time, it's also the skill set is also of the quant also on the buy side. I mean, what you do is relevant on the buy side. Additionally, having that right mindset would help. And for that mindset, you can project yourself, not just project, rather invest yourself for a while, build that mindset, create some track record. And then when you apply to buy side, where you say that I have this skill set from my professional job, where I do modeling, I do quant, I know all of this, I've done this. And as an investor, I've also got the right mindset. I am active on Value Picker. I have written these reports for myself. These are my investing notes. These are my exit notes. This is the portfolio I maintain. I can think long term. I can fit in the profile you're looking for. That's how you can justify without taking a major haircut. But if you lack that and you still somehow convince them, then they might convince you for a haircut. So that's the trade-off you're looking at.
Got it. Thanks a lot. That really helps.
Ashish, you can go next, please.
Yeah, thanks. First of all, Jatin, thanks a lot for this wonderful presentation. And I personally am very impressed by the growth that you had. I just have this question that you said that we look at both the quants. Some of them look at the quants, some of them look at the quality. Now, I just want to say, if a company is not doing well, but you know that the promoters are good and the company has a lot of, let's say they have good moats and everything, how do you convince the investors, or how do you convince your clients when the numbers are not that good, but you have the conviction that overall on the long run that they will do good? So how do you quantify the qualitative factors? That's what I want to know.
Hi, Ashish, that's an interesting question.
Yeah.
See, that's the difference between value and growth, right? In growth investing, numbers do the job. You don't have to sell the stock every year. Company is growing, and it justifies the stock price or the growth. Whereas in value or contrarian bets, it's not obvious in the numbers yet, but you study things deeply. You take a call on cyclicality or the transition of the business, or there could be a management change, there could be a change of strategy, they could be doing some things differently than what they were doing earlier. And those are the insights you have to get to be able to get the confidence to buy the stock even before it becomes very obvious in the numbers. Because once it is obvious in the numbers, it's for everybody to see, right? And then you will not get it at those valuations. So you get better at this by repeating the process. Sometimes you get it wrong, sometimes you get it right. But for us, the most convincing point is in such opportunities, if we see extremely limited downside.
Yeah.
But if things work out the way we envisage, the stock can go up multifold. So when you're not paying for that optionality and you have a large upside, and even if you go wrong, there is nothing to lose. Those opportunities are called like heads I win, tails I don't lose kind of opportunities.
Exactly.
And they are great to have in the portfolio. Of course, there is an opportunity cost. So you have to take care at the position sizing level. There is risk management there. You also have to have a cap at overall such position in the portfolio. You can't have a portfolio full of such opportunities. These are alpha generating opportunities when they work, and they don't become a baggage when they don't work, other than the opportunity cost. So once you have done that in the past and some of your opportunities worked and they multiplied money, it's easier to repeat the process.
Yeah, great. I have just another sub question, if I may.
Sure.
Yeah. So this is more on the emotional aspect. As you have just said, that you went through the first cycle, that is where you had the bull run and the bear run that you have experienced. So when it comes to bear run, emotionally, how do you convince yourself, and more importantly, how do you convince your clients that don't lose out right now? Instead, if you have some more cash, put it right in, it will pay rich dividends in the future. So how do you convince yourself first, and how do you convince your clients?
See, both are difficult to do, especially at times like COVID when you yourself are clueless.
Exactly.
So it is difficult to convince yourself, and it is even more difficult to convince somebody else.
Exactly.
So in my case, during COVID, I thought a lot about it, and it also helps to surround yourself with smarter people who have seen cycles, who are positive in life. It's very easy to picture a doomsday scenario and convince everybody, right? In such times, you find very few optimist people. So I'm very lucky. I'm surrounded with very senior people who have seen multiple cycles, and despite all the ups and downs, there have been rags to riches story. So when you see those live examples in front of you, and you also reach out to them during such times, it immensely helps you psychologically. And once you settle down yourself, then you gather the courage to disseminate that opinion and slowly convince your clients also. So in my case, I wrote a memo in March 2020, and I gave an example that imagine you bought a land for 10 lakhs, and next year the weather was bad and the crop got destroyed, and now somebody is coming to you and asking to resell it at 5 lakhs. Would you do that? And the answer is obviously no, because it's just one lost harvest, right? This land is going to give higher and higher yields every year for next 100 years. Some lost harvest cannot reduce the value by 50%. Exactly, that was the case in COVID, right? We could have lost 1, 2, 3 years, but the intrinsic value of majority of the businesses cannot go down by 50, 60, 70%. So we explained this with this analogy, and I'm so happy that this analogy made sense to a lot of our subscribers. In fact, most of them, and very few who were in their first cycle might have got shaken out, but almost everybody stayed the course. They invested more money, and the results are for everybody to see. So we have to keep our calm during such times. You should not take decisions in panic. That's been my learning.
Okay. Thank you, Jatin. And it was wonderful listening to you. Thanks a lot.
Thank you. Most welcome.
Yeah. So it was quite an exciting session, Jatin. So there were a lot of practical tips to be taken from the session for the audiences. So if I list down a couple of them, initially your journey said that you be focused on it. And then you give practical tips on to, how to apply in the job, or how to project yourself in the interview, or how, for that matter, even, going and telling them if their investments are wrong. That was quite a fascinating new tidbit I got to know. So I'm very much sure that, today all the younger participants have got immense value out of our session today. I really thank you for taking out time and meeting with us. And Vidhi, to be sure, do we have any more questions from attendees?
I guess, Nand Kishore just now raised his hand. So maybe Nand Kishore, do you want to ask one quick question, please?
The last question would be, sir, do you use any kind of technical analysis, and how do you, one more thing is, do you do the purchase is once, or is it over a period of time that you guide your clients to keep purchasing at every interval or something like that, keep seeing the performance and then you keep increasing it?
Okay, so the first question, Nand, was on technical.
Right.
So both are technical and fundamentals are very different school of thoughts, right? And it's very difficult to be good at even one. So attempting to be good at multiple makes it very, very challenging. Having said that, I had covered this in my learnings in the CFA session also, that technicals also matter. Generally, fundamental guys bullshit technical and technical guys bullshit fundamental. But I think they both coexist and they both matter. there are certain circumstances where technicals can add value to even the fundamental guys, especially at the time of buying and selling. We don't proactively apply too much technicals, but we are aware where they matter, and though we don't take decisions based on them, but we are aware and we do understand the value they bring to the table.
Okay.
So that is the answer to first question. The second one is just to add to first bit, we sometimes look at them in terms of exit, in terms of technical analysis, because fundamentally you bought something at 100 and you thought intrinsic value is 200, but in a good market that can go to 500 also. So as a fundamental value driven guy, if you end up selling at 200, you're leaving a lot of money on the table. So when momentum gets added to your stock, it makes sense to ride it, even if you think it is overvalued. So how you do that with stop loss and all, it's all individual strategies, but over the years, we have tried to inculcate some bit of appreciation and acknowledgement of technicals, at least in the exit process. That's the complete answer to your first question. Now, the second question was, what is the right buying strategy? If you have a lot of money and you are fully convinced on the stock, it makes sense to buy it right away. Let's say you want to buy a 5% position, you go ahead and buy 5% allocation. But if you're short on cash, you are, or the idea is a bit experimentative, or you expect near-term challenges, you don't expect triggers, positive triggers to play out very soon, you can stagger your investment and buy slowly. Generally for our clients, it is lump sum followed by SIP when people join us as a subscriber, whatever 10, 20, 50 lakhs they bring to the table. We make them slowly invest based on the buy ideas. And over time, as they bring more capital through SIP route, whatever ideas are on the buy list, they keep adding them over time.
Got it. Got it. Understood, sir. Thank you so much for this, sir. Thank you.
My pleasure.
Yeah. So with this, we come to an end of the Q&A session. So Jatin, I sincerely thank you on behalf of CFA Society for taking out your time and providing value to our audiences. As I mentioned in my conversation earlier, also, I'm 100% sure that there are a lot of practical tips in your conversation today, which audiences, if they apply, definitely they are going to get results out of it. So I thank you, each one of you, for joining us on a Friday evening.
Excuse me. Hi, Rajni. I have a question as well. I don't know. I just raised my hand. If you did. Could I ask my question as well?
Yeah,
if
quickly
that's
you can
okay,
ask. Jatin, do we have permission to take this last one?
Yes, please. And my email address is jatin@stalwartvalue.com. Anyone wants to reach out can reach out later as well. Aniket, what's your question? You can.
Hi, Jatin. First of all, thanks for the input and sharing your learnings with us. My question is, so I'm preparing for level run right now. And I'm interested more in venture capital roles because you kind of look at the fundamentals of the business, and you also look at what the business, what's the prospect of the business in long term and short term as well. So do you think that is something where CFA would be really helpful? And secondly, the second question that I have is, what is your take on this whole GameStop phenomenon that happened in the US equity market last year, where there was a bull run driven by a few thousand investors on Reddit, and they were kind of pooling their resources and just investing in the company. Do you think that kind of phenomenon can happen again as well, or was that like a one-off event that won't happen ever again?
Hi, Aniket. So on your first question, what do you expect me to say on the session organized by CFA Institute? I have to say CFA is relevant.
Yeah.
With just jokes aside, CFA is relevant for whatever you do in finance, because it's pretty broad based, right? There are 10 subjects.
Yeah.
And investing is investing, whether you do it at VC level, angel level, PE level, public markets, pipe. Investing is investing. Within that, of course, at an angel or VC level, there are certain other aspects you see which you may not give that much importance in a listed company. And those subtle differences, those nuances are there, but otherwise investing is investing, and CFA really prepares you end to end, no matter what profile you join. I think as a CFA charter holder, as a CFA coach, I think it adds tremendous value no matter what subdomain you join. And also as a designation, as something on CV, it definitely helps you stand out from the rest of the crowd. So I would definitely suggest go ahead, do it. The second question was about the whole GameStop saga. So we live in a connected world, right? And the advent of social media and all 700-800 of us globally being so connected, things can go wild on either direction, right? We have to be prepared. This was just one of the things, but there have been so many other instances, whether positive news, negative news, everything flows down so quickly, which makes it very easy to speculate and manipulate things also. So when millions of retail investors pool their resources, it becomes a giant institutional investor, right? And you can move things when you have that many flows being influenced. So there have been so many examples, what is happening in crypto, what is happening through SPAC, what is happening through micro caps in US, defunct companies, no business, but look at their stocks, how they're getting influenced, or so to say manipulated. So we live in interesting times here. Now, either you can just be a spectator and enjoy, or if you wanna try your luck, and if you are those speculator types, you join the gang. That's how it is becoming so popular, because everybody is joining the gang thinking we'll also make money. But what's happening is either you be too early or you don't participate at all, because if you participate late, the early ones will benefit at your cost once the trend reverses. So it is pure speculation. It is almost illegal, and eventually there'll be regulations around this, I'm sure. I am just a spectator. I am not participating in any of these fads. I am a conservative value investor. But I know people who are participating in the fads. Some have made money, some have lost their pants. So to each his own. But such are the times we live in. Yeah, it's a connected, crazy world.
Thank you. Thank you so much.
So with this, we come to an end to our Q&A round. So as a formal vote of thanks, I thank you, each one of you, for joining us on a Friday evening. I'm sure that it was a session with a lot of value add, wherein you can go back and apply to your professional life and definitely make a difference to it. Thanks a lot, Jatin, for taking out time from your busy schedule and doing a session for CFA Society India. On behalf of CFA Society India, I thank you very much.
Thank you, Rajni. Thank you, Soumik and Vidhi, for organizing this. And thanks to all the participants for coming and interacting. It was great sharing my journey, and I hope some of it would be helpful to you as you move forward in your CFA journey. Thank you so much. Have a great weekend.
Thank you. And we conclude the session.
Thank you.